4.5 trillion, huge amount of money, but it's about 25% of GDP. Bank of Japan's balance sheet is 100% of GDP. So compared to other central banks, it's not extraordinarily large. I think there are some arguments, not necessarily for keeping it where it is, but not for getting all the way back to sort of pre-crisis levels, and has to do with the fact, for example, that when you have a big balance sheet, you have this reverse repo program that allows money market funds to essentially invest with the Fed, gives them a safe short-term asset. There's some evidence that a larger balance sheet makes monetary policy more effective because it transmits interest rates into the economy more effectively. So there's a number of reasons like that. I think that what the FOMC is going to do, though, is they're going to reduce the balance sheet. They're going to want to maintain more bank reserves than before the crisis because they want to run monetary policy with a large amount of reserves. There's reasons for that. So I don't think they are going to go back to the pre-crisis level by any means. But I don't think they also haven't bought the arguments I've made about keeping it sort of relatively large.
What's the right level, do you think?
Well, I think that for them, I mean, so it depends on how you buy all these different, how much you buy these different arguments. I think they're aiming for something in the vicinity of 2.3 to 2.8 trillion, something like that, which would allow, first of all, the fact that there's a lot more currency. Believe it or not, you thought we were going to have a cashless society.
More currency.
But there's a lot more currency in circulation today than there was 10 years ago. And the Fed has to have a balance sheet to accommodate that. And then in addition, they've got to have some bank reserves so they can manage monetary policy effectively. So that's the kind of number that you get.
Now, can you get growth over 3% in this country?
On a sustained basis, it's certainly possible, but probably not that likely. I think if there's a big tax cut, for example, that lowers tax rates, you might have a bump because there'd be increased demand, increased consumer spending.
That gets you over 3%?
Probably not. I would take the under on that. I would take the under.
That's interesting, given that, of course, the president has said repeatedly all he wants to do is get over 3%. In fact, thinks he can ultimately get to 4%. You think that's not even possible?
Well, you know how good economists are at forecasting, and I'm an economist, but I would have to say that's a pretty long shot. And the reason is, we're not in the same world we were in 20, 30 years ago. In particular, our workforce is growing much more slowly. So just pure demographics, number of people available to work, is not consistent with 4% growth. And then, at the moment, we're kind of in a lull in terms of the application of new technologies to
what could it do to unemployment in this country? And I know you think we're close to full employment, but when you talk about some of the policies that have been laid out by the administration, they are hoping to goose the economy and to goose jobs in particular. What's the lowest rate you think you could legitimately get to, given some of the policies that have been talked about?
Yeah, I think of this, the full employment as kind of a zone rather than a single number. But clearly we're approaching the level of unemployment whereby it's just much harder to get it much lower, because if you do, it's just going to be hard for firms to find workers. It's going to start pushing up wages and prices more quickly. So the Fed would probably react to that if
we do want wage growth, though.
We want real wage growth. We want wages to grow more quickly than prices. But if you get a wage price spiral where you're just running to stay where you are, that's not really helpful.
Have you had conversations with either Steven Mnuchin or Gary Cohn about these views?
I've had one meeting with Gary Cohn where we talked about a number of issues, regulatory and other issues. I've not met Secretary Mnuchin, so no.
Is it a problem to try? In other words, okay, let's say the secular stagnation story is right. Let's say your story is right, that because of population growth and productivity growth at the moment, we're kind of in this 2% range. Doesn't it make sense for the administration to do things that would essentially effort higher growth? And if it fails, I'm not sure there's all that much downside.
Well, it depends on the type of policy. But yeah, no, I didn't mean to just say that. You were asking me if we could get to 4%.
Right.
I don't think
but
that's
it's not a problem to try.
Not if it's smart policies. For example, the infrastructure. Look around. Obviously, infrastructure in America is not where it should be. And some smart investment there could make us more productive. That could help longer-term growth. Tax reform, make the tax system more efficient. That would be helpful.
So when you add all this up, just one second, sorry, Becky.
Go ahead.
What do you think is a better reasonable target? I've heard a lot of people say, you know what? If the president can add a half a point, go home and declare victory. Because a half a point is a lot, and if it's sustainable, it creates a different outcome than if it's a one-time bump up to 3 and then you go back down to 2.
That's right. Well, I would just suggest trying to do smart policies that improve productivity and improve potential. And if it's 2.5, great. If it's 3, even better. But there's lots of things that affect growth, so you can't really you can't fine tune that, but you can try to move things in the right direction. Well, I think so far so good. It wasn't too long ago when people on shows like this were saying that we were going to be having hyperinflation and huge stock market bubbles and dollar collapse and all kinds of terrible things were going to come. But in fact, it's gone pretty smoothly. The Fed is on the process of exiting from easy money. The economy is doing pretty well. The unemployment rate is 4.5%. Inflation is close to the Fed's target. All those things are on track, looks like.
And you say in the new afterword to your book, which is The Courage to Act, out in paperback with this new afterword, that you think the economy is ahead of where you thought it would be at this point.
Well, if you look at those kinds of cyclical indicators, like GDP growth, we're about 12% above the peak, the pre-crisis peak. We've made everything up that we lost, plus 12%, 16 million jobs, 4.5% unemployment. Inflation is fine. Stock market's up, housing market, all those things are looking good. So on those indicators, if you had told me 3-4 years ago that this is where we'd be, I would have been pretty happy.
Would you have been surprised if we told you 3 or 4 years ago that we would still be largely in all of these extreme measures, that the balance sheet is still this big, that we still haven't raised rates by much?
That I would have been surprised, but what's happened basically is that we've seen that the interest rate environment, not just the Fed's actions or ECB's actions, but just the fact that the interest rate of that's needed to get to full employment is just much lower, and that's just a long-term thing. It comes from global savings, it comes from low returns on new capital investments. So the Fed's very low interest rates are not as stimulative as it would have been 10, 15 years ago, because we're not that far from where interest rates are neutral. Central banks are reacting to the environment, not creating the environment, in that...
That's what I'm trying to get at. Is it a chicken and egg scenario?
So Larry Summers, secular stagnation, he says basically that we're in a world of slow growth, demography, population is not growing so quickly, the workforce is shrinking in some places, technological change has been relatively muted, at least in terms of GDP recently. So the rate of return on new capital investments is, at least for now, is kind of low. Meanwhile, around the world, you have lots of savings looking for opportunities. And so the neutral interest rate, forget what the Fed is doing, the neutral interest rate where we're going to end up appears to be a good bit lower than in the past.
Do you buy into secular stagnation?
Well, parts of it. I mean, I think we are in slow growth now. And I'm not as pessimistic as Larry for two reasons. One is I think that productivity will pick up. We do have a lot of promising technological changes on the horizon, for example. And productivity recently has just been unusually low, and I think it's going to do better. And the other reason is I think part of the reason for low interest rates is something I've talked about in the past, which is global savings glut. There's a lot of savings being dumped on the world market by countries like China, which at least until recently were buying up a lot of assets. And that is also pushing interest rates down. So I think that they'll probably go up some in the future. The BAT, the border adjusted tax, it's very interesting. I mean, some of the best public finance economists, Alan Auerbach, people like that, have advocated this system, and I think it's been sold in kind of a bad way. It's not really about trade. It's not really about imports and exports. It's about where revenue is taxed. And the idea is that revenue should be taxed where it's earned, so that if you sell exports, you don't get taxed on it because you're earning those revenues in another country, and vice versa. So it has a lot of appeal in many ways. For example, it eliminates the incentive for companies to move their headquarters for tax reasons. It eliminates some of this transfer pricing where you're fooling around trying to figure out where the profits were actually booked versus where they were actually earned. So in many ways, it's a good system. I think a couple of points. So one is that it is politically going to be a very tough sell. But secondly, the transition problems are pretty serious. So for example, in order for the system to work the way it's anticipated, you would have to see a very big appreciation in the dollar. Some people say 25%. And that would have a lot of side effects. It would, for example, affect the debt positions of emerging market economies that have borrowed in dollars. It would affect the wealth of Americans who own foreign currency denominated assets. So there are a lot of big transition issues to worry about. So I think, I'm kind of on both sides of this one, because I think it's very interesting in principle, but it's hard to get from here to there. Well, I miss some parts of it. I miss a lot of the people. I miss having 200 great research assistants. Anything you want to know, you get. But I'm certainly happy to be a civilian and not have to make those decisions anymore.
Do you think Janet Yellen would miss the job if she's not reappointed? And I ask this because there has been so much speculation about what Donald Trump will do with this position.
Well, you have to ask her. I think that she'll have mixed feelings one way or the other as well. I mean, it is a very tough job. Congress has been very hostile at times, and she's had to deal with that. And it's, of course, it's a tough job, the herding the cats at the FOMC. But again, it's a very satisfying job. You're doing important work, and it's really interesting work. So, I'm sure she thinks about it both ways.
Do you worry that the Fed has become much more politicized over the last 8 to 10 years?
Well, not the Fed itself. The Fed is a nonpartisan institution. It is not political.
The reaction from Congress,
yeah,
and from the presidency at this point.
I mean, I do worry about it. And obviously, there have been various bills and proposals to curtail the Fed's independence, which I think would be a big mistake. I think, though, to some extent, it's not so much that the Fed's actions are causing partisan reaction. I think in some sense, the high level of partisanship is causing the reaction to the Fed in the sense that Republicans in particular, when I was appointed by George W. Bush, and he was very sympathetic to the independence of the Fed, very good on those counts. But I think perhaps because the Congress perceives the Fed as having been supportive of Obama's recovery, perhaps, or for whatever reason, it's now an article of partisan faith to be aggressive against.
But people blame you for that. People blame the extraordinary actions of the Fed.
I was going to say, it's the
right?
extraordinary actions and the Fed doing things that had such a huge impact on the economy that hadn't before, that probably changed a lot of people's
Well, but if that was
paid more attention.
If that was the reason, then given that those things seem to have worked, that we haven't had the inflation, that the economy is recovering, that the U.S. is doing much better than other industrial economies. If that was the reason, you would think by now people say, "Oh, okay, we were wrong. You're right. Sorry." And but that's obviously that hasn't happened.
There's other criticism of the Federal Reserve that Joe not being here, I have the obligation to play Joe's role here. Yeah. Stan Druckenmiller and Kevin Warsh both have this concept out there that extraordinary actions by the Federal Reserve, in particular quantitative easing, where you bought all these bonds, has created companies going out and buying back their stocks. Giving more dividends instead of actual capital investment.
It doesn't make sense. I mean, if you have very low cost of capital, all else equal, that's going to make firms more willing to invest. The reason they're not, it goes back to the beginning of our conversation. We're in a world, again, I don't entirely endorse secular stagnation, but I think it is true that the rate of return to new capital investments is low in a lot of places. And so firms with lots of cash, lots of profits, they can't reasonably invest it all. Some of it makes sense. In a capitalist society, that you give the dividends back through the buybacks to the investors, and they can redeploy those assets elsewhere. Right. From a cyclical point of view, the economy has recovered. From 2009 until today, unemployment has fallen by more than half. We've tremendous increase in jobs. It obviously has improved a lot. Housing market, all those things are very positive. But of course, the Obama's successor, or hand-picked successor, did not win, and obviously there are some longer-term issues in the economy, from inequality to low participation rates and so on, that a lot of people weren't happy about.
Some people call it the Bernanke recovery. Do you give him credit for this?
Well, I think the Fed was certainly part of the process, and even if it was the Fed, obviously I'm part of a big team, and we worked together. We worked internationally as well, but again, I would just say that that the cyclical recovery, the Fed's policies have certainly been one factor in that.
There are a lot of people who look at it and say the reason there's so much discontent is because the people who were at the bottom recovered the least, if they recovered at all. All of the moves that brought up the stock market make well-to-do people feel much better. They got richer along the way. People who were left behind weren't necessarily left behind. And I remember at the time the Fed was saying, look, we have to do this. You lift all boats. When you save the economy, you lift all boats. But it certainly helped the wealthiest Americans more than anybody else. And maybe that led to the inequality.
That's not true. That's not true. The Fed's policies contributed substantially to 16 million new jobs, the declining unemployment rate. The people who benefit the most from that are working class people. It's very interesting. There's all this talk about how the Fed's policies help the rich. Lately, when the Fed was thinking about raising rates, it was the hedge fund guys writing op-eds saying, oh, rates are too low, the Fed's got to raise rates, whereas people like Fed Up, who supposedly represent workers, are saying, no, keep rates low. So if it was really the case that the Fed's low interest rate policies were helping rich people, I would think you would get that politics going the other direction.
Although you hear people who say the savers are the ones who got killed. Those are retired people on fixed incomes. Those are the ones who are dealing with much lower returns than they had anticipated during their retirement.
Well, but rich people save a lot more than poor people, right? So how can you say
they also plow a lot more money back into the stock market, and the stock market did so well.
Well, that's true, but you know, and I don't mean to deny that low interest rates have caused problems for some savers, absolutely, and I'm sure you'll get lots of calls on that. But I would say that the low interest rate environment in the world we see today, which is not just the United States, it's all around the world, is less central bank policy and more just the fact that we are in a slow growth world now with slow population growth, slow productivity growth, which means the rate of return to new investment is low. And that is something that the central bank can't do much about. Well, I think GDP is an important number. It gives us a good sense of what the current level of activity is. And lots of things it leaves out. It doesn't take into account distribution of income, for example. And I did a blog about that. It doesn't take into account a lot of things which aren't priced in markets, like clean air and people working at home. So I think the answer to that is not necessarily to change the GDP number, at least not materially. There are lots of technical changes you can make, like seasonal adjustment, for example. But just to add other data that people can look at, you know, what's happening to income distribution, for example, what's happening to small business formation, things that matter to policymakers, but don't necessarily have to be in the GDP number.
You talked about productivity and the weak numbers, and you've given a lot of reasons, demographics, other issues that are out there. But you also mentioned at the top of the hour infrastructure, how that might actually help. And I started thinking about how many hours we all spend in traffic, how much that's increased. I know just from a personal perspective over the last 5 to 10 years. And it's not just here in New York City, it's everywhere I travel.
Sure, sure.
How much of a drag do you think that is?
Well, I don't have a number to give you, but I mean, just everybody's everyday life, you know, how much time you spend in traffic, you know, construction or other problems that are blocking
hours and
blocking you or the airport.
Even at 5 in the morning.
Yeah. And there's other things too, you know, what about our schools? What about what about bridges? What about airports? There's so many different things that could be improved. Now, I'm not talking about make work. I think you need to be smart. You got to make sure that you're getting your money's worth and that you're actually improving the situation. But I think this is one area where I think we've fallen behind somewhat. And when you travel abroad, as I do and you all do, you know, you see a lot of countries where it just seems a lot better than here.